So, when it comes to your money, what if I told you that one of the most common numbers you rely on, the average, is also one of the most dangerous? Yeah, you heard that right. We're always told to look at the average return on an investment, but that single, simple number can hide a ton of risk. We're going to break down exactly why going beyond the average isn't just a good idea, it's absolutely crucial for your financial future. You've probably seen some version of this classic cartoon before, and honestly, it hits the nail on the head. The river averages 3 feet deep, sure, but that average is just hiding a 1 foot shallow end and a 10-foot deep hole. Relying on that simple average gave our poor statistician a fatal sense of security. This is exactly what Stanford's Sam Savage calls the flaw of averages. It's a funny cartoon, I know, but the question it raises is dead serious. Are you building your most important financial goals, like your retirement, on a simple average that completely ignores the deep spots? For way too many people, the answer is, unfortunately, yes.
And look, this isn't just a gut feeling, it's a well-known principle in statistics and finance. As Professor Savage puts it, when you plan for the average, you're pretty much guaranteeing your plan will be wrong. Why? Because the real world is never average. It's messy, it's volatile, and it's full of extremes. Okay, so let's see how this plays out with a typical retirement plan. Let's say you've got a $200,000 fund and you're assuming a 14% average return, which is kind of typical for long-term stock market investing. A simple online calculator might tell you, hey, you can take out $32,000 a year and your money will last for 20 years. On paper, this looks absolutely perfect, right? Well, you know what they say. Reality has other plans. Let's run a simulation using the actual stock market returns starting back in 1973. Now get this. Over this period, the average return was still 14%. But look what happens. Because of a few really bad years right at the beginning, the entire fund is completely wiped out. Gone in just 8 years. Okay, let's try that again. Maybe it was just a fluke. This time, we'll start in 1976. The average return here was actually higher, 15.3%, so it should do even better, right? Nope, the fund still runs completely dry in only 10 years. So what in the world is going on? If the average is the same or even better, why do these plans keep failing so spectacularly? And here's the absolute key takeaway. The average return just doesn't tell you the whole story. It's the path you take to get to that average that makes all the difference. As we just saw, a few terrible years right when you start withdrawing money can completely wreck a portfolio, even if amazing years come later. The sequence of your returns, the wild up and down swings, the volatility, that's the real story. So, if the average isn't enough, what do we need? Well, we need better tools. We need ways to measure the spread, the potential range of outcomes. And this is where we dive into the whole concept of volatility. The fancy term for this spread is dispersion. Just think of it as the range of possibilities for your investment. So an investment that could swing anywhere from up 15% to down 20%, well, that has a really wide dispersion. It's a wild ride. On the other hand, something that pretty much stays between up 5% and down 5% is a lot more stable. Now, how do we actually measure this? The go-to tool in finance is something called standard deviation. You'll see it represented by the Greek letter sigma. It's essentially just a single number that tells you how spread out your returns are from the average. The bottom line? A higher standard deviation means more volatility, and that means more risk. But, standard deviation isn't perfect. Because of the math behind it, it squares the differences. It gives a lot of extra weight to extreme events, like a huge market crash. And that can sometimes make things look riskier than they might be. That's why some experts actually prefer a different measure called mean absolute deviation, or MAD, which is less phased by those big, wild swings. We're going to stick with standard deviation here because it's the industry standard, but it's good to know it's not the only game in town. Okay, so we can measure risk using standard deviation. That's great, but how does that actually help us make better decisions? What we really need is a way to compare the risk we're taking to the reward we're expecting to get. And that brings us to our next big idea, the risk-to-reward ratio. Think about this. It's a super common dilemma. Do you go for the investment with a higher return, but also higher risk? Or do you pick the one with a slightly lower return, but much, much lower risk? Just by looking at these numbers, it's not obvious what the best choice is. We need a way to connect the risk to the reward. And this is where a brilliant little metric called the coefficient of variation, or CV, comes to the rescue.
It's an incredibly simple but really powerful tool that solves this exact problem. You just take the risk, that's the standard deviation, and divide it by the reward, the average return. What you get is a single, clean number that tells you exactly how much risk you're taking for every single unit of expected reward. Let's make this real with a quick case study. Let's say we have an investor, we'll call him Fred. Fred's looking at 3 different options: a portfolio of individual stocks, an ETF, which is like a basket of stocks, and some government bonds. The stocks offer the highest potential return at 14%, but whoa, also the highest risk. The ETF has a slightly lower return, but it's a lot less volatile. And then the bonds are super low risk, but also offer a super low reward. So when we crunch the numbers and calculate the coefficient of variation for each one, the answer becomes crystal clear. The ETF has the lowest CV at 0.54. This means it gives you the most bang for your buck, the most reward for the amount of risk you're taking on. It's the most efficient choice of the 3. For investors, a lower CV is almost always better. All right, so understanding the theory is great, but how do we actually put this into practice? How do you build a portfolio that can actually survive the reality of volatility? Let's get into some real actionable strategies. First up, the foundation of any tough portfolio is smart asset allocation. The whole goal here is to own different kinds of assets that don't all go up or down at the exact same time. So you combine things like stocks or equities for their growth with more stable investments like bonds. Then you might add real assets like real estate to protect against inflation, and you always keep some cash ready to jump on opportunities. Now, even within the stocks you own, you can play defense. You can actively look for companies that have a history of really stable earnings and rock-solid balance sheets. These are usually the market leaders whose prices just don't bounce around as much as the rest of the market. And what's cool is research has actually shown that these boring, low-volatility stocks can generate higher returns over the long haul with way less risk. Another really powerful defensive strategy is to focus on dividends. Just think of dividends as a little cash reward the company pays you just for being a shareholder. Companies with a long, stable history of paying them give you a reliable stream of income, no matter what the market is doing. That cash flow acts like a cushion during downturns, providing a nice buffer against all that price volatility. All right, now for a more advanced idea, let's flip the script. What if volatility wasn't just something you had to protect yourself from? What if you could actually use it as an opportunity? Okay, I have to give a big word of caution here. These next strategies are for sophisticated investors, and they can be really risky. But it's good to know they exist. Some traders use tools that track the VIX, which is often called the market's fear index, to try and profit from all the uncertainty. Others use complex option strategies that can pay off if the market makes a big move, whether it's up or down. There are even funds designed to go up when the market goes down. The key thing here isn't that you should go out and do this, but just to understand that for advanced traders, volatility itself can be an asset. So let's bring it all home. We know markets are going to be turbulent. Uncertainty is the only thing we can be certain about. The flaw of averages shows us that planning for a smooth, easy ride is just a recipe for disaster. So the real question you have to ask yourself is this: is your financial plan built for a simple, convenient average, or is it built to withstand the messy, unpredictable, and volatile nature of reality?